Hello, everyone. My name is Graham Parham. I'm with Highlands Residential Mortgage. I am here today to talk about something that a lot of people don't understand even today. Is called the 1031 tax exchange. And who better to talk about a 1031 tax exchange is my friend Greg Larriman. He's with API, which is a Asset Preservation Inc., which is a highly recognized 1031 exchange intermediary. And he's been doing my exchanges for years, done a bunch of 1031 exchanges with a lot of his customers, and I wanted to pick his brain today. And here joining me, of course, is my production partner, Aaron Stelly. And we're just going to kind of put you up on the tee there, Greg, and just fire a bunch of questions, and let's see how it comes out.
Perfect.
So the 1031, it is a tax-deferred exchange. You have a property that you own as an investment property. You sell it, you take the proceeds from that, and you go buy another one. And if you don't use the 1031 exchange, then of course you have to pay the capital gains to the IRS. That's why the 1031 exchange was developed back in, am I saying this right, Greg, 1921? Is that a good year?
That's right.
Okay. And to address, allowing for the tax to be deferred if it's handled through the 1031 intermediary company. And I'm sure it's had many revisions since the launch in 1921. We could talk about that. But one of the things that I do know is one of the biggest mistakes people do on a 1031, they do not plan. Okay. And that's the biggest mistake. So let's go back in time. 21, they launched it. We've had a lot of revisions. It's now to the point where we are today. We're going to talk about, the mechanics of it. And I'm hoping not to get into any political nature, because I think our current administration is trying to frown a little bit and how long we're going to keep that 1031 on there. Would you care to share comments on that?
Well, we have faced threats every few years for 102 years. It's pretty easy. I put easy in quotes. It's been fairly easy for 102 years to knock down any efforts to take it away. It's not easy in terms of how much effort it takes to re-educate people in the government about why it's there. But once we educate them, it's so obvious a first grader can figure out it's not a good idea for an elected official to take this away. This was put in the code, like you said, in 21, because farmers said, we can't sell a farm and buy a more expensive farm if you don't give us a way to do that. Because if I'm selling dirt, I'm selling it for more than I paid for it, and I want to buy a more expensive farm for my family, I'm just helping my family. We're just regular people just trying to farm a little bit more. But if we move all our money from one piece of dirt to another, we can't pay taxes with dirt. And so it doesn't take a whole lot of brain power to understand that if people can't pay taxes with dirt, they're not going to sell and buy anyway. And that's not going to help the government if people can't sell and buy. So just about anybody in government knows that every time they make it easier for people to sell and buy real estate, it creates jobs. People like Graham in the lending industry, we're going to get him because we're going to charge him ordinary income rates. That's the highest rates. So the more deals that Graham Parham can do, the more money he's going to make, and then he's going to pay the government ordinary income taxes, and same with real estate agents and title companies and gardeners and everybody. So it's a no-brainer. It's about as elementary as it gets. So when I say it's easy, is after we spend a year meeting with them and, of course, contributing to their campaigns, and mainly getting National Association of Realtors involved, which is very powerful. We knock it down. It's knocked down again for the foreseeable future. It's not going anywhere right now. Right. So we'll just keep on going until we start hearing a little bit that someone's getting the bright idea to do away with this, and then we'll all have to work again to re-explain it to people. Now, by the way, Graham, this is one of the few things that actually is bipartisan, and that'll probably shock everybody, because actually both parties have their own reasons why sometimes they think, well, let's take this away. Biden was going to do it to he was either going to take it away or limit it to $500,000 a year deferral to help pay for programs. Well, Paul Ryan tried just as hard to take it away. Why would Paul Ryan take it away? A conservative Republican, his number one goal was to lower corporate rates. And people said, okay, you got to do away with other stuff if you're going to lower corporate rates. You got to balance it out. So that's why he tried so hard to take away 1031s, at least as hard as Biden did. And but we explained, wait a minute, taking away 1031s, it's not going to pay for lowering the corporate rates. People aren't going to sell. It's going to be a job killer. When you're in office, you want to show that you increase jobs. So that's it, Graham. So we're good for now.
Good,
Again.
good. I do remember back before 2008, there was a lot more players in the playing field for intermediaries, and some were not so good. And I do recall, that 08 was a bit of a struggle for everybody, and whoever was left on the playing field is still here today and still very credible. So I really don't run into a lot of issues with intermediaries today like I did before, which is a good thing.
Right.
Aaron, I know that you have some questions, and if you'd like to, tee up a couple of questions for Greg, that'd be great.
Yeah, and thank you for joining us, by the way, Greg. But I'd like to actually kind of piggyback off of what you were just kind of mentioning, Graham, there, and that, maybe since 08, the playing field for the intermediaries has shrunk a little bit. But, being an intermediary yourself, Greg, what would just be, we have a lot of borrowers where, the 1031, as they do work to build and accumulate their portfolio, it's obviously a viable, great move for so many options. But as borrowers do kind of embark on this 1031 path, what should they be looking for when they're, looking for that intermediary to help them out? What are, what questions should they be asking as they kind of, reach out and try to find someone, to help them ultimately with the 1031? What's some good questions they could kind of put in their arsenal to ask as they do their due diligence?
Yeah, exactly. There's only 3 words you have to know about this topic. It's like, kind, and exchange, and qualified intermediary. That's all you got to know. Okay. None of those words, and none of those words mean what they say. So you got to get everything out of your brain. The first 2 words are better than they sound. So the more you learn about those, the more you can be on offense. The 3rd word is a lot worse than it sounds, and you want to learn that word to be on defense. So, and to back up a minute, the biggest mistake people make in 1031s is not knowing about it. Now, how do you blame them? You can't blame them. All you can do is have people like Graham and Aaron getting the word out. The biggest thing that needs to happen with 1031s is to constantly get the word out. I can't think of anything that's more beneficial to people that's still lesser known. And after 102 years, can you believe that? So, so I will get to the QI deal. Talk about the positive first. You can do this with like, kind property. Okay. So here's where you get into mistakes where people make them, even if they've heard a little bit about it. So maybe they've heard about 1031s, that they're good. And then they hear, well, you got to buy like, kind property, and they don't want to buy the same kind. So like, kind is a billion times better than that sounds. This applies to any real estate in the US that you're either running your business out of or holding for investment. And if you're selling that, you don't have to pay taxes if you do a 1031 and buy like, kind property. Guess what you get to buy and still call it like, kind property? Any interest in real estate anywhere in the country that you're going to run a business out of or hold for investment. So for anybody that's they start out as a single family investor, they want to go into multifamily, they can sell some single family homes, and they can buy an apartment complex. They can buy commercial real estate. They can buy a farm. They can buy a vacation home if they do it right. That's one of the many things that they need to call me about, because those are fact specific, but it is very broad. That's broad. So that's great. Like, kind is better than it sounds. I mean, exchange is better than it sounds. Exchange sounds like, well, wait a minute. Oh my gosh, exchange sounds hard. I got to go find somebody to exchange with. Exchange is just a word. Talk about something that's just a word that doesn't mean what it says. Exchange, all it means is you're going to sell investment or business real estate. You have a company like ours have some papers at the closing that calls it an exchange. And then we hold your money and you go buy something else. You identify it within 45 days. You close on it within 180. And if y'all want to go into that in more detail in a minute, that's great. Right now, I just want to cover the big picture, that the whole thing boils down to like kind is great. Exchange is easier than it sounds. And now getting to the word you brought up, which is not a fun word, but that means it's just as important to learn as the fun words. And that is, you said, Aaron, you said, what do you look for in a qualified intermediary? Well, not only does like kind not mean like kind, and exchange is easier than exchange, but qualified intermediary. Okay. They say that all you got to do, you don't have to exchange with anybody. If you just sell your property and have a third party hold your funds and you follow a few other rules on identification and closing within 180, just put your money with a qualified intermediary. We're making it easy for you. They did that in 91. Before 91, they were hard. 91, they made them easy. Have a qualified intermediary. We're going to call this third party a qualified intermediary. Guess what? There's nothing qualified about qualified intermediaries. There's no qualifications to be a qualified intermediary. So the definition of a qualified intermediary, it includes everybody in the universe that's not disqualified, and they don't disqualify people that embezzle other people's money. They don't disqualify people in prison today. They don't disqualify people who've never read the tax code. They only disqualify the person's relatives and agents. It literally means just someone who's independent, and they don't have to know anything to fit that definition. They don't have to be honorable. They don't have to have a background check. It's a third party. It's a third party that's not related to you or connected to you. It is only an independent third person. So the good news is that's pretty easy to say, okay, I don't care what the IRS thinks a QI is. I'm gonna make up my own definition. And the easiest way 95% of the people do it is say, okay, QIs are not regulated, but I can hire a QI that is regulated, right? The answer is yes. So a lot of people, they hire a national QI that's owned by a national reputable title company. And then if the terms are like ours are, the national title company backs what the QI does. If any employee of the qualified intermediary that's owned by a title company has the right wording, just like ours does, and I think they probably all do, then that parent company of the title company actually has to pay the client for any losses. So that's the way you deal with this lack of regulation, lack of testing, lack of knowledge requirements. You find somebody that does have knowledge and integrity and security. And in a lot of cases, most of them, there are some exceptions. You can find some QIs that have good knowledge and the right kind of security that aren't owned by a national title company. But kind of the easiest way to just kind of knock it with an axe and get right to the point and hit it with a hammer, just a good national title company that's done over 200,000 exchanges like we have, that's owned by a good solid title company. That is the way most people take care of themselves, because the IRS isn't taking care of them on this part.
I couldn't agree more, Greg. I mean, you want to go with a national credible company. And if you're trying to save some money where, okay, Greg's company is going to charge you this amount of money, but this other company over here is going to charge you a discount, still do your homework, because even before like the 08 bust, we have a lot of people that claim to be QIs that never gave the money out. They took the money and ran. Am I right?
Right. Yeah. There's a top attorney in Texas. I started to give the city. I won't even give the city. Who said, he said, my client had a 1031. I told him to use y'all. And he was this kind of big talking, loud mouth, ego driven guy. And he said, no, I found my own QI and they're charging $200 less. That guy lost 3.1 million bucks over that.
Well, you got to pay. I mean, I hope people listen to what we're saying today, because that's so important. One of the things that you touched on is like kind. I had a guy a couple, 3-4 years ago, sold a gas station and bought 3 single families, and that qualified as like kind. So people, it's a very, very broad definition, if you will. And there's, I mean, the best way to determine, can I sell this and buy this? Talk to people at a qualified intermediary to make sure. And I'd like to commend Greg and your staff. They're wonderful. They're great. I personally used them. Oh, I can't begin to tell you how many times. Greg, you got a couple offices, one on the East Coast, one on the West Coast, I believe.
That way to take care of, yeah, the early morning and the late evening, yeah, cover the most hours we can, yeah.
But you know, they can't be tax advisors. We understand that, but they can help you manage the 1031. A good example is one of your staff, which I love doing business with. I was selling two pieces of property. I was going to sell one here on the 1st of the month and one on the 15th, and I was going to set up two individual exchanges. He said, "Well, just make it all into one." Can you explain the stipulations around that? If you combine those two together, when can you sell or when can you buy the first piece of property and so forth?
Yeah, so you can combine as many sales and purchases into the same exchange that you want to. And there's always going to be trade-offs. But with yours, the reason it works is your second sale was coming so soon, because even though you can add a bunch of sales to your first sale in one exchange, the first sale dictates the deadline. So you only add sales to one sale when those subsequent sales are going to happen pretty quickly, and you want to use it to roll into one big property. So each case is different. That's why I still enjoy this after 28 years. It's still interesting. Every case is different. And so sometimes, yeah, you may want to put a bunch of sales into one purchase, or you can put one sale in a bunch of purchases. And that's even more common because people love being able to diversify. Maybe you sell a rental and you buy a rental, but you got 50,000 left over, and that's not enough to buy another property, but you don't need the money and you don't want to give it to Uncle Sam. You know, there are a couple of products that qualify, such as well, oil and gas royalties are kind of the biggest evolving thing, one of the most popular ones. So literally you can dump 50,000 left over into oil and gas royalties and just get cash flow off of that, and you don't have to do a darn thing. And there's something called a DST, stands for Delaware Statutory Trust. To make it simple real fast, most of the Amazon warehouses are set up to where people can put money from a 1031 into an Amazon warehouse. And of course, Amazon's not going to call you when the HVAC goes down. You know, that's all put together by a sponsor. You don't ever have to do anything. And you get your share of the rent every month and your share of the debt pay down from their rent. So you could even go into something passive and just with leftover 50,000, 100,000 even.
I would want to find out where these other avenues are. Like you say, if I got 50, 100 grand left over and I don't need the money, I don't want to get hit by Uncle Sam. How do you find those avenues where you can? Is there a website, or you just have to call you? I mean, this is new to me. I haven't heard of it.
You just have to call a good connector like myself. You know, let's take a good title person. I used to be in the title business, as you know, Graham. And even though I was in the title business, I would always think, how do my people sell title insurance? It's the same thing. The state mandates the price. How do you sell title insurance? Well, some of the best title company sales and marketing people is people that knows everybody, and they just love making everybody else happy. And then people bring them their deals. And so they put people together. I want to contrast the one-off thing that I can't help people with the mailbox money that I can. I've been asked, every 1031 company I know of has been asked this question a million times because it sounds like it'd be perfect. We get calls once a week. Somebody says, I've got this property and it'd be perfect for a 1031 investor. Well, there's no way I can keep up with all our exchanges and figure out who'd want that property. That's why you got full-time brokerage. We have a whole industry that's called real estate agents. That is that's a full-time job to figure out who's selling what and who wants what. So that's a needle in a haystack. I maybe once or twice out of thousands of exchanges have I connected with someone on a one-off deal. So that doesn't work. What does work is the three forms of mailbox money are volume. So I know people who can deliver good mailbox money, and I'm open to, people connecting with me and letting me know why I should connect people with them, because that is what's feasible. The three forms of mailbox money are triple net lease. So that's where you buy a Dollar General. You don't have to do anything. So if somebody just wants passive real estate that qualifies, triple net lease, I can connect them. It's still with a broker, but there are brokers that specialize in that. And then on the DSTs and oil and gas, it's a matter of, I know people that I would invest with, in fact, have invested with. So I can't recommend anybody, but I'm certainly allowed and happy to tell people, here's who I invest with, and here's who a bunch of my clients have raved about. So I can be a connector on mailbox money, not on one-offs. Hey, you're looking for this property with these characteristics.
One of the things that I know I've seen a lot of times, Aaron and I have seen it so many times, where somebody will call me up, hey, I sold this property so-and-so, I'm in the middle of an exchange, but I have to identify the next 10 days. And, that's a bit challenging these days with low inventory. So the key that I can only express, being I've done exchanges myself and dealt with people that are scrambling around to find an asset, because a lot of times if somebody that has 10 days left on an exchange and they go to a real estate agent, or say, I see your property listed over here, I'm doing an exchange, I want to buy it. I mean, they may price it out of the roof. They may say, okay, it's going to cost this. Don't overpay for an asset just because you're down to it. My best suggestion is, if you're really thinking about selling the property, okay, fine. You got to go do your due diligence on where I'm going to place that money. I've had 3 opportunities in the last 12 months to sell properties, but I'm so scared and nervous that I can't find another property that, as you say, is like kind or better. So I just kind of held off on selling. So the key is planning. Okay. You got 40, and you're going to help us with the mechanics here. You've got 3 stopwatches. As soon as that sale goes off, 45 days to identify 1, 2, or 3 properties. We're going to get into that. And then, of course, 180 days to close on those properties. So can you take us through the mechanics of the identification, the 180, how many properties they can buy, your 200% rule, and just the kind of the basics?
Right. Yeah. Yeah. So the first thing is, as you know, you and Aaron know, Graham, one of the main keys with a 1031 is you got to contact somebody like us early, so that we can explain everything to you and get documents to the closing. When I say early, the earlier the better, but we don't delay things. We're back up to speed. During at the height of the boom, we weren't getting documents out as fast as we had always been able to for 30 years before that. And we're back up to speed. So I actually have a call right now. Just got off of a phone call. Someone's closing tomorrow, and we probably can do it. But you just talk to us as early as possible. It has to be, the bottom line is, as you know, it's got to be at least before the closing. Once you close and fund, if you didn't set up as a 1031, it's too late. So another call I get about once a week is, hey, Greg, I want to do a 1031. I just sold a property. And I say, well, what do you mean by sold? Because also we know people use words differently. Sometimes they mean sign a contract, which is great. Sometimes they mean closed, which is fatal. Too late to do a 1031. If you tell me you sold it, meaning you closed. So first you got to set up the 1031 before you close, and we can do that fast, even though that's not the best way to do it. A week is better. We consider that ideal. We consider that forever, a week, and that's not very long. And then you're right. So the clock starts ticking, and you've got 45 days to just fill out this sheet of paper we send you, and we calculate your deadlines for you. Technically, there's 3 options for identifying. One of them is so inadvisable to rely on that you just want to talk about the 2 words you mentioned, the 2 ways you mentioned, 3 property rule and the 200% rule. The 3 property rule says you can list up to 3 properties. If you only list 3 properties, they can be of unlimited value. And then, but by day 180, you can close on 1, 2, or all 3 of those. If you want more than 3 properties as options, now you go to the 200% rule that says, we don't care how many properties it is, as long as the value of all of the choices you list doesn't go over double your gross sales price. So you're limited to either 3 properties in number or 200% in value. Now, typically, if you're buying a DST or oil and gas royalties, a lot of times you're buying a little interest in a bunch of properties. So all you got to use is the 200% rule. And I don't have a lot of people saying, well, I wanted to list twice as much as I sold. So you can use the 200% rule. And then, yeah, you got to close by day 180. If you don't close by day 180, it still fails, whether it was your fault or not. I had one a few months ago. They were buying from 7 owners. 7 kids had inherited a farm. There were 7 owners. Unfortunately, one of them was in prison, and he kept playing around with them, playing around. Well, yeah, I'll sign off if you pay me this, pay me that. I'll be darned if 180th day went by. He didn't accept anything. He didn't sign. The exchange failed. So that's too bad. So you do have to close by day 180 no matter what. Now, on the flip side, you don't have to wait till that. Like you're saying, Graham, you can line up properties ahead of time. That's ideal. You're even allowed to put down earnest money on a replacement property before you close your sale, and you get that money back tax-free. So the ideal way to do a 1031 is actually tie up a property to buy contingent on your sale. Now, during the boom, we all know it was hard to, you weren't a very competitive buyer if it was contingent, but we're getting a little bit back to normal. At least it's good to know the ideal, or you can do that. You are allowed to put down earnest money if you can do that. You don't want to feel like you're being sloppy or not being in the ball game if you're not. I would say still only, even though you can do that, I would say I'd say probably less than 15% of my exchangers actually have a contract to buy something before they close their sale.
Which is the ones we like to work with, because all too many times we run into that same situation. I had a client once, Greg, that over-identified. In other words, they could probably buy, let's just say 3. Okay, they identified and wrote in or gave that information to you. I'm going to do 6. Okay, and let's say they only closed on 3. Is there any repercussions on that? They identified 6 and only closed 3.
Yeah, no, there's never any penalty for not closing on everything you list at all. That's
Okay.
just giving you your maximum. That's giving you your maximum. Now, what really applies to your business is some people think that if all they reinvest is their gain or all they invest is their equity, they defer all of the tax. No, to defer all the taxes, you got to reinvest your equity and replace your debt, either with new debt or new cash.
Which is typically called boot in the industry.
Yeah, yeah, it's boot if you don't do that. Yeah.
And for simplistic reasons, what you're trying to explain to the audience is that if you had a house that you bought and it was, let's just say you sold it for 100,000 or 200,000, and there was a lien on it for 100. Well, to avoid the 2 boots, the equity boot or the cash boot and the loan boot, you have to get at least 1 or 2 loans or however many to equate to at least 100,000 or more, and you have to have a sales price for 200,000 or more. Okay,
Right.
But you can go beyond that 200,000 on the cash price as long as you satisfy the loan as well, and you can do more than the 100,000 on the loan. So those are the 2 boots. A lot of times that we run into that, we explain to our clients, you're not using up your available equity, or let's adjust the loan amount and so forth. So yeah, that's really good. One of the times I was doing an exchange, and I let's say the 3% rule, and I was actually doing 4. I think, is there a 95% rule saying if you close 95% of that? Can you go into that part?
Yeah, that's the rule I said is so inadvisable. I don't even mention it. Yeah, but it's worth mentioning because if someone's reading, they may get confused. Wait a minute, why didn't Greg mention the 95% rule? The 95% rule says if you fail to meet either the 3 property rule or the 200% rule, we're going to qualify the exchange if and only if you wind up successfully closing on 95% of what you listed. So if you don't say either within the 3 property rule or the 200% rule, that means you're listing a lot of property. So most people say, well, it's not very prudent to roll the dice and count on closing on 95% of what you listed. If you think about it, let's say you list 19 properties. Do you know 18 out of 19 is not even 95%? So the 95% rule means you're counting on being lucky enough to close on it all, pretty much. Yeah. So that's why we don't spend much time talking about it, but it's worth raising. I'm glad you raised it in case somebody's reading and saying, oh, I found another rule. Yeah.
I got a crazy question, and I know Aaron, I'm taking a lot of time here because I know you had a whole bunch of questions too.
No, this is great. This is great.
Let's say, and say hello to your wife, by the way. But let's say a guy or a family, whatever, had a house they bought. It was a primary residence. They lived in it, say, for 5 years. Then they moved into another house and they started renting that, the one they lived in out. Okay. How long do they have to rent that property out before they sell it and be able to qualify for an exchange?
Yeah, great. And first of all, I'm gonna back up on that one too. Oftentimes the primary residence rules are even better than the 1031 rules. So first, you always want to check to see if the primary residence rules help you, because with the primary residence, that's 121. If you sell a property within 3 years after you move out, a married couple gets a $500,000 gain anyway. And then they don't have to do a 1031. But of course, now that we've had so much appreciation, even with a little bit of cool off, people have so much appreciation in almost all their real estate, including their home. All of a sudden, $500,000 gain exclusion doesn't go that far. And so that gets to your point. If you move out, you just have to have the intent to rent it long term. That generally means a couple of years. So it generally means you would rent it a couple of years. The 2 years is not hard and fast in the code. It would just be safest to rent it. But once you've rented a couple of years, then you can sell it. And believe it or not, you could use both rules. But to use the primary residence rule, it had to have been the primary residence 2 of the prior 5 years. So if you moved out and rented it out a couple of years, when you sell it, well, you still had 2 of the prior 5 years was primary residence. You get to use your $500,000, but now it's a rental. You can do a 1031 with the rest. That's pretty amazing. So to answer your question, generally, once you move out of it and you intend to rent it, safest to wait a couple of years. And if you don't wait that long, it's safest to at least get past 1 year. The shorter you do it, and then you still want to claim it as a 1031, you just got to prove it. You weren't flipping it or just fixing it up to sell it. So these are rough rules of thumb, but at least 1 year or 2 is better. But of course, you want to sell it before it gets to 3 years, so you can use the primary residence exclusion if you want to do that. It may be that you think the best thing to do with your money is to keep that property as a rental and just keep renting it. Yeah.
I have one more question. Let's say you did your exchange and you had that $50,000 left and you say, well, I guess I'll just go ahead and take it. Are they taxed at their bracket? Are they taxed on a different percentage? I know you're not an accountant, and that's why I was hoping the accountant could be able to answer that, but I'm sure you know the answer.
Well, yeah, each person has to check with their CPA, but they take all their income and then they add this income to it. But now the federal tax, I can't answer the fact that the federal capital gains tax is anywhere from 15 to 23.8%. So if you're in Texas and one of the other states that has no state income tax, 23.8% is the maximum. Now, technically, our two federal capital gains rates are 15% and 20. Where I get the 3.8% tax, the Medicare tax can come in too. So it can be the highest federal capital gains rate right now is 20. And then you can have a 3.8% Medicare tax. And like you said, it's each person's situation. The ranges, when you start creeping up there, are like around between 200,000 to 450, like a single person. They get into the Medicare tax after 200,000, a married couple 250, and then on the higher capital gains tax, it hits you at 400,000 for a single person, 450 married. At least that gives you a big picture.
So in other words, I get this happens or asked all the time. Well, if I don't buy this property, I've got $50,000 and I'm going to take a tax hit on it. And they say, I'm going to take it at let's just say somebody's at a 38%. So that's not necessarily true. It's at the 20 or the 15 to 23%. And I've been using 21 as a rule of thumb, and I'm going to continue to use it, but I'm glad you answered that question.
Yeah, because it can be a blended rate. Some of it may be 15%. Some of it could be 18.8, because you can have a 15% capital gains rate and still have the 3.8% Medicare. So it's all blended in there around that 200,000 to 450,000. It goes from around 15% up to 23.8% federal. But you and I both, do business all over the nation. So some people have a heavy state tax on top of that. We do tons of 1031s. They're selling in California. It's got a huge capital gains rate, and they buy in Texas. It's amazing that you can do that. You even defer the state tax, even when you sell in a income tax state and buy in a non-income tax state. Even the state defers the tax, on that. You're supposed to report back to them, and if you ever sell without doing a 1031, the actual word that's called report and clawback. They claw back their taxes now, but you can, if you do 1031s your whole life, the state doesn't get you, the feds don't get you. You can do this. You can swap till you drop. You never pay the tax, and when you die, unbelievable. Your heirs get a step up in basis, and the tax goes away forever.
And Aaron, I apologize one more time, but you just brought up something that is viable. If, let's just say I die, okay, and I've got 50 properties. My wife, does she get penalized from the federal tax, or is there some way that that's avoided? Seems like there is.
She, well, in a community property state, what's bizarre is when one spouse dies, the surviving spouse gets a step up in the whole dadgum thing. So that everybody needs to check with their CPA.
Okay.
But no, she at a minimum, she gets a step up on if you own half of it and she inherits your half from her, she absolutely gets a step up in basis on your half. But also, I believe, and you can check with your CPA, in most community property states, the surviving spouse gets a step up on the whole thing, even the part that she already owned.
All right, Aaron, it's your turn.
Oh, that was great. We just kind of naturally knocked out about all my questions that I've kind of got jotted down here. I was curious though, Greg, we touched on, hard stop after the 180 day. If you blow through that, it's busted, no go. What about the identification period? What if we get past that 45-day period and, for whatever reason, we've missed that? Is there any way to kind of resolve that, or, it's kind of done at that point as well?
Yes, the same thing. It's the same thing. They do allow you to switch out your properties during the 45 days. Absolutely not after that. Not after that. So that's why you generally want to use up whatever rule you use. Let's say you only want to buy one property. If you pick the 3 property rule, you might as well list 2 backups. That's the purpose of that. So they do contemplate the fact that properties fall out and you want some backups. They don't give you near enough. So we'd all like it to be broader, but nobody brings it up because we don't like being on the radar where they say, well, let's just take away the whole thing. So, so yeah, it's hard and fast. That's why you generally want to use up your whole rule. If it's 3 property rule or 200%, Not always, but generally, you got a trade-off. Are you going for the most chance to defer the most tax and have the most successful exchange? Or do you want to be able to get your money back the quickest if it fails? And that can get really complicated. But what I mean by that is, as long as you have a legal right to do a 1031, a 1031 company is not allowed to send you your money back. You can use your money immediately to buy real estate. So if you're at close to the 45th day, and whereas normally if you pick the 3 property rule, you'd want to list 3 properties so you have backups. But if you're somebody that really knows, hey, I just want this one property, I don't really want backups, especially if that means my money's going to be tied up. So if people want their money to be freed up the soonest, then you just got to watch out for that. Once you get past the 45th day, the flip side of the fact that you can't add properties, guess what? You can't take off properties. Why do you care about that? All that you care about that is, as long as we have a property listed, we're not allowed to give you your money back until 180. So it's not the worst case is your money's tied up 180. And it doesn't.
I've got a question related to that.
Yeah.
Reverse exchange.
Yeah.
It's expensive. It's a pain. How often do you do those?
So about 3%, about 3%.
It's not very common, but obviously a lot of times you probably don't advise them to do the reverse because of the expense involved. Is that correct?
Right. Yeah. Just to help them, to save them money. We say, okay, it's great that you found what you want to buy and you've got it tied up, but see if you can postpone that closing until you close on your sale. Because whereas we can do a regular exchange in one day for $1,250, it takes us 3 or 4 weeks to set up a reverse, and it costs us about $9,000. So that really cuts into your savings unless it's a big commercial deal.
Exactly.
Yeah.
Exactly.
Yeah.
Well, Greg, this has been tremendous, and I really appreciate the time. I learned even more today about exchanges than I never did. I've done so many of them, and I quite frankly think that our company, Highlands Mortgage, is a very user-friendly mortgage company to deal with on exchanges, because there's so many lenders out there that want to arbitrate a 1031, and they stick their finger into the pie too many times. And they say, no, we can't do this because of that, or we can't do this. But, it's like, as an example, I did an exchange a year ago. I had it in an LLC. It was single member. And then I exchanged it over into another property, but I put it in my name and not the LLC. Well, you can do that as long as it's single member. So there's a lot of little quirky things involved that your account executives can explain. This can be done and this cannot be done, because there's so many things that we could spend another 2 hours on this webinar talking about that, but I just want to kind of get the general gist of it. And I really do appreciate your time.
You bet.
What's the best way to get a hold of you or any of your account reps to talk about 1031?
You want to call me directly. I guess the broadest number would be 866-266-1031. That's my cell phone, even though it's an 866 number. 866-266-1031. I have a local, my underlying number. I operate all over the country, and especially office wise, I go back and forth between Dallas, Fort Worth, and Austin. But 817-300-3851 is the fundamental phone number into my phone, 817-300-3851. And Greg at apiexchange.com is my email, greg@apiexchange.com. And I'd love to help you, whether it turns into an exchange or not. I talk people out of doing exchanges when it doesn't qualify or it's not worth it or whatever. I'm happy to talk to people and do what's in their best interest, whether I get paid or not.
Thank you, Greg. And if for any reason you guys want to get in touch with Greg and you didn't get all of what he just said, please give us a call or holler at us. My number is 855-326-6802. We really appreciate your time, and have a great day.